I'm Connor.
I'm Liam.
And I'm Sage.
And here's a little something to wake everyone up for our presentation.
That was a switch spin. So it was like a 360 wheel kick to the...
Well, whether you like it or not, that was a pretty impressive kick. So our presentation is called Bigger Than the Fight. We felt that it was a pretty provocative title for what most people would assume is just a wrestling company. You'd probably describe TKO Group Holdings before today as the wrestling people, maybe the UFC, but we're going to talk about what it actually is. It's a global media infrastructure company that generated $1.16 billion in free cash flow last year in 1 year in 210 countries. We're going to spend this presentation explaining how that works, why the model is so powerful, and where TKO goes from here. So we got four numbers here. We have $4.7 billion in revenue, $1.6 billion in free cash flow, $1.3 billion returned to shareholders, and 210 countries. So that last number, 210, that's where our presentation really lives. TKO reached a global audience, but it still earns most of its money in only a small number of markets. The gap is the entire strategic argument. It's both the problem and the opportunity. So if we were presenting this live, this is where we'd look around the room and ask people a quick question. We'd ask them if they think TKO's revenue went up or down from 2024 to 2025. So the actual answer for that is the answer is down. It was down about 3%, but the headline number is pretty misleading. In 2024, TKO had the Paris Olympics through On Location, its premium hospitality business. That made 2024 unusually high, so when the Olympics were gone from the 2025 comparison, total revenue looked a lot weaker. But underneath that headline number, the core business was still growing. UFC grew 7%, WWE grew 22%, and management guided about $5.7 billion in revenue for 2026. So the lesson here is pretty simple. The headline number is almost always the wrong number. Our job is to find the numbers that actually explain the business. So what is TKO actually? TKO Group Holdings as a combined company is still very new. Before 2023, UFC was part of Endeavor, the entertainment conglomerate. WWE was separately publicly traded. Then in September of 2023, they merged into a new company called TKO. So in February 2025, TKO completed a $3.25 billion acquisition of IMG, On Location, and Professional Bull Riders. So this is not just UFC and WWE anymore. It's UFC, WWE, IMG, On Location, and PBR, all being integrated at the same time. At the same time, TKO is pushing harder into site fees, where governments and host markets pay large amounts to bring events to their cities. And that context matters because TKO is already profitable, but it's not fully settled. It's still trying to figure out what kind of company it wants to become. Liam is now going to show you what it looks like inside the business.
Yeah, thank you, Connor. So TKO's business is built around two major brands. It's UFC and WWE. And UFC is the company's content engine, founded in 1993 and acquired by Endeavor in 2016. UFC now hosts more than 40 events each year with over 700 athletes competing globally. The company has a major ESPN media deal and operates in more than 200 countries with very strong profit margins. WWE is the company's intellectual property powerhouse, founded in 1952. It has built decades of recognizable events and characters like The Rock, Stone Cold, John Cena, and the most recent superstar Logan Paul. WWE also secured a major long-term Netflix deal and continues to attract multiple generations of fans. The key takeaway, we can keep on that side there. The key takeaway is that the real value is in the brands themselves. Fighters and wrestlers may change over time. The UFC and WWE brands, events, and global recognition are what create long-term value for TKO. So UFC and WWE are the main attractions, but TKO also has three important assets working behind the scenes. First is IMG. IMG gives TKO a major role in sports media, talent representation, and global rights management. It connects TKO to major broadcasters and events around the world. Second is PBR, which is professional bull riders, and PBR brings in a loyal fan base and gives TKO more live event inventory in markets that UFC and WWE may not be able to fully reach. And third is On Location, like Connor mentioned before, TKO's premium hospitality business. It creates high-end event experiences for major events like the Super Bowl, Olympics, and FIFA World Cup. And the main point is that TKO is not just UFC and WWE. Those are the biggest brands, but IMG, PBR, and On Location are the infrastructure that help TKO scale. So TKO's real product is attention. The company creates massive audience engagement and then turns that attention into revenue through three main engines. First is live events. TKO hosts more than 500 events each year with millions of fans attending. These events create excitement, social media attention, and fan demand, which helps grow future events. Second is media rights. Strong viewership leads to larger broadcasting deals with companies like Netflix, Paramount, and Fox. Better media deals allow TKO to improve production quality, which then attracts even more viewers. Third is site fees and intellectual property. Governments are willing to pay large amounts just to host major events before the tickets are even sold. And on top of that, TKO earns additional revenue through licensing, gaming, streaming, and branded content. And the result of this is high profitability. UFC and WWE both operate with high margins and are much higher than many major entertainment companies, showing how powerful TKO's business model really is. Now let's look at the financial performance behind the business. So in 2025, TKO generated about $4.7 billion in revenue, $1.585 billion in adjusted EBITDA, and more than $1.1 billion in free cash flow. Both profitability and cash flow grew significantly year over year. You may notice that the revenue is slightly lower than 2024, but that was mainly due to the temporary boost from the Paris Olympics cycle, and UFC and WWE themselves were still growing strongly during that time. The bigger story is 2026. TKO is projecting between 2.24 and 2.29 billion in EBITDA, which would represent roughly 44% growth in just 1 year. And the growth is expected to come from WWE Netflix deal, higher UFC media revenues, IMG's post-Olympic recovery, and the FIFA World Cup hospitality package that have $1 million collected in advance. The company's margins are also improving rapidly, increasing from about 22% to 33% in 1 year. And the key takeaway is that TKO is not just growing, the business is becoming more profitable and scalable at the same time. And now we'll hand it off to Sage.
All right, thank you, Liam. So we're going to look at TKO and its peers. So when we map TKO against its competitors with intellectual property depth on one axis and global reach on the other, one thing really jumped out at us is that TKO sits in the top right corner by itself. Nobody really combines this kind of IP depth with this much global reach, and it literally doesn't have a peer group. So we did what the analysts do and compared TKO to media companies instead of sports companies. We did Netflix, Disney, Amazon, Live Nation, and that's where the pattern gets interesting. So TKO has the highest gross profit margin of anyone on that list at about 76%, but it trades at 16 times forwards earnings. Netflix trades at over 30 and Disney's is north of 20. So what that means is either the market hasn't caught up to what TKO actually is, or it sees the risks the company has to fix. So our take is that it's both. And the good news is the risks are ones that TKO can actually do something about. So to figure out what actually is going on at TKO, we used 3 independent lenses and looked for where they disagree. So the first is the boardroom vision, essentially what TKO says about themselves. Mark Shapiro, the COO, put it pretty plainly. We take the UFC playbook and apply it to everything. I mean, site fees, rights escalations, back-end synergies, and by the numbers, he is right, the model works. The second is what the outside analysts are saying, and this is where we start to see a warning. The argument goes, if you treat your fans purely as customers to be squeezed, you break the bond that created the premium in the first place. There's a domestic rights ceiling, and it looks like TKO might be approaching it. The third lens is our own analysis. We talked to multiple fans directly and scraped data off of Reddit, specifically from r/UFC and r/WWE. And both sources said the exact same thing, and that's that piracy is rising. And it's not because fans can't afford it, but it's because the access model is fragmented. So when you stack these three together, here's what you get. The boardroom is seeing growth, the fans are seeing a price wall, and that gap is the strategic problem that TKO has yet to publicly address. And our verdict is that TKO needs to pivot from extraction to ecosystem value, and they need to do it before the 2026 rights cycle forces them to. Coordination is the next edge, not further expansion. So this is the point in time where we would ask everybody to show us a hands and ask them who pays for more than 2 streaming subscriptions right now. We'd let them raise their hands. And we'd say, keep your hand up if you've ever found a free stream for a UFC or a WWE event. We'd almost inevitably see a couple hands. Jake, an interviewee, already told us that he does that. $4.7 billion in revenue, and someone we interviewed and someone in this room both agree that they have used a free stream for these events. Our group conducted multiple interviews across different age groups and viewing habits and pulled data again from Reddit to validate this, and multiple sources are finding one consistent thing. So one of the people we interviewed, Jake, said, I'll find a stream if it's a big fight. Another person said, if the UFC and WWE were together in one platform, I'd definitely consider that. Melissa, another one, says that it feels bigger and more polished, but a little less personal. And another one, Daniel, who was a 30-year UFC fan, says that it feels more corporate than it used to. And so what we're seeing is that the fans are telling TKO exactly what to build, and the company just isn't listening. So here's what's happening at a systemic level. This is where the data we just walked through becomes a structural problem. So 4.7 billion in total revenue last year. About 54.5% of that comes from media rights, and those rights are controlled by about 3 companies. And here's what management has told the market they'll earn next year. They've said 5.6 to 5.8 billion. So the trajectory keeps going up. But watch what's happening underneath that number. Revenue's going up, and fans are getting priced out. The rights are consolidating in fewer hands. That's not a growth story. That's a scaling trap that TKO is walking straight into. So the model is working for now, but the real question is, what breaks it? What happens when the day Netflix decides it would rather own a combat sports company instead of license one? What happens when Paramount walks into the next rights renewal with all the leverage? So TKO has a narrow window to build a fan ecosystem deep enough that no single media buyer can hold the company hostage, but that window is closing. I'm going to let Connor take over for the next bit of this.
Yeah, so like Sage was saying, the basic diagnosis here is that a lot of the stuff is working. UFC has a 57% EBITDA margin. WWE has a 52% EBITDA margin. There's no real off-season to these sports, and site fees can cover production costs before a single ticket is ever even sold. But there's also problems that come along with that. Fans are dealing with higher prices, content is split across different platforms, and the $375 million antitrust settlement made the fighter pay issue harder to ignore. So our fix is pretty straightforward. Getting one ecosystem login, site fees used to keep base level access affordable, and a 24-month pause on major acquisitions so TKO can integrate what it already owns. What does not fix the problem is buying more assets before the current ones are fully connected. So this is the core strategic choice. If we were presenting live, we would ask everyone to act like TKO's board and choose one of these 3 paths. So option A, is keep returning capital, protect margins, maximize media right fees, and trust the current model. Option B is use IMG, build a unified TKO system, lower media rights concentration, and use site fees to keep fans in the system. Option C, acquire another streaming platform or media partner before fixing the fan access problem. So all three of these sound reasonable at first, but each one has a major trade-off. So since this is recorded, we obviously can't run the vote live, but the question still remains the same. If you were on the TKO's board, which path would you choose? Well, we decided that our answer would be B, but with some discipline involved. And that distinction matters because diversification only works if TKO does not overextend itself. Option A is viable, but it's a pretty static option. It assumes that the media rights money keeps coming in the same way forever. And option C is the one that we cut. Buying more before fixing the fan experience would make the problem just a lot worse. And you cannot acquire your way out of a fan trust problem. Option B is our main recommendation because it gives TKO the best long-term upside. But the keyword is discipline. Option B only works if TKO also keeps the financial discipline of option A. So our strategy is not just to spend more, it's to diversify the business while staying disciplined. Sage is going to explain the first part of that strategy, the unified ecosystem.
Right on. So let's look at his first recommendation. It has two halves. The first half we'll start with is the supply side. So TKO already owns all the infrastructure it needs. On Location has almost $300 million, as Liam mentioned prior, $300 million in FIFA 2026 hospitality packages that are just sitting in restricted cash on the balance sheet. They're pre-sold, prepaid, they're waiting to be deployed. IMG manages rights for over 100 external sports properties, and that infrastructure is already generating revenue. So the strategic goal is to use it to diversify away from their media right owners like Netflix and Paramount. So right now, as we mentioned, media rights are about 54% of their gross revenue. So by year 3, our target is 42%. Not by cutting any of the deals, but by expanding on everything else that they already own. So as you can see, the supply side is working. What I want to look at next is the fan side. So this is our fan side recommendation. For the first one, and it's a TKO Plus. So it's a single subscription with one login, and it combines UFC on Paramount, WWE on Netflix, and internationally via their WWE network, and Professional Bull Riding's 500 event per year library into one unified product. The fan research validates this directly. One literally said that they would definitely consider a unified catalog. Another also stated that everything being so separate is what makes them not watch. So the precedent exists. Disney Plus bundled Hulu and ESPN and grew to 150 million subscribers. TKO has that exact same structural opportunity. We estimate that 5 million subscribers at about $14.99 per month, $15 a month in North America and Europe, about $5 a month in South and Southeast Asia, would generate roughly $900 million in annual recurring revenue by the third year. And all of this is coming from a product that essentially doesn't exist, and it's just waiting to happen. So to us, it's a coordination problem, and TKO already owns all the intellectual property to solve it. So I'll let Connor take over for the next recommendation.
Yeah, so recommendation 2 is the site fee subsidy. So the idea of it's pretty simple. If government's already paying TKO huge fees to host events, TKO should use part of that built-in margin to keep regular fans in the building. Like Saudi Arabia already pays over $50 million just to host one event. So that money exists before the ticket sales ever even start. Right now, TKO could keep all of that as profit, but we think they should use some of it to lower the base tier prices. That matters because our research showed that piracy is not really a content problem because the fans want the content. The issue is the price and the access of the content. So the model is keep VIP prices high, keep regular tickets more affordable, and then convert those fans into TKO Plus subscribers over time.
Yeah, thanks, Connor. So recommendation 3 is probably the most important one people miss. We recommend that TKO pause any major acquisitions for the next 24 months and move forward with the $2 billion stock buyback already discussed by management and introduce progressive dividends. And right now, TKO is already balancing a lot, like we've discussed, integrating the UFC and WWE merger, expanding internationally, and launching new streaming opportunities. And there was also a recent $375 million antitrust settlement, which shows the risk of growing too aggressively, too fast. And the stock buyback sends a strong message that TKO believes its current brands and business model are already extremely valuable, and progressive dividends would help attract long-term investors while reducing pressure for short-term growth decisions. And with TKO's current financial position, the company can realistically do all three. This isn't a step backward, it's a strategy to stabilize the company and support long-term growth. So here's the implementation plan. It's just a little recap of how all three recommendations will be working together. So obviously, like Sage was mentioning first, TKO strengthens its ecosystem by creating a more connected fan platform across its brands. And then second, the company expands internationally through long-term partnerships and balanced event pricing strategies. Third, TKO focuses on stabilization and shareholder returns through a pause on acquisitions, stock buybacks, and dividends. And the overall goal is simple: stabilize, strengthen, and then scale for long-term growth. So here are three major risks that we're not ignoring, and just kind of sum up of things we've talked about before earlier in the presentation. So first is fighter pay. In 2024, UFC paid a $375 million antitrust settlement, like I just mentioned, tied to athlete compensation, and that showed the financial and reputational risks TKO faces if these concerns continue. And our recommendation helps by creating more stable revenue streams and more accessible fan pricing. Second is execution risk. TKO is still a young company managing multiple brands and large initiatives at the same time. That creates pressure internally. This is why we recommend a pause on all major acquisitions so leadership can focus on successfully integrating and strengthening the current business. And third is media rights renewal risk. Paramount and Netflix currently make up over half of TKO's revenue, as we mentioned, which creates heavy dependence on outside partners. Our strategy reduces that risk by building TKO's own ecosystem, growing TKO Plus, and strengthening direct relationships with fans before future negotiations begin. And the main idea is that these risks are real, but they can be managed with a more stable and focused long-term strategy. So before we ask for your final vote, there's one more number to look at. And TKO is projecting $2.27 billion in adjusted EBITDA for 2026, as we slightly mentioned before. And that's the company's own guidance, not our projection. It represents about 44% growth from 2025. And that growth is expected to come from WWE's Netflix deal, UFC's Paramount agreement, stronger IMG performance after the Olympics cycle, as we mentioned before, and continued international site fee partnerships. And this is before our recommendations are fully implemented, obviously. So the final question is simple: would you invest in TKO? And I'll hand that off to Sage to go further into that.
All right, so let me just give you a data recap. TKO's market cap is roughly $10.9 billion. Their gross margin is 76.4%, which is the highest versus all the peers we compared them to. Forward price to equity is about 16.3 times. Free cash flow yield is about 10.5%, and 2026 EBITDA guidance is up 44%. Net leverage is at a conservative 1.6 times. So compare that to the median: $28 billion market cap, 52% gross margin, 18.7 times forward P/E ratio, 5% free cash flow yield. So in this scenario, this is where we would ask the class, all right, if you had $10,000 and TKO was on your screen, would you invest in them? And yeah, we'd let them vote. We can go to the next slide. And then what we would say is, after they vote, we look at their stuff and show everybody, and then we would reveal that our answer is conditionally, yes, we would invest. So 16 times forward earnings on a business with a 76% gross margin means that the market is pricing TKO as a mature, stable business with limited growth. We think the market is wrong about the growth, but this is only if TKO shows up with a healthy fan ecosystem before the rights cycle renegotiates. Right fees alone won't fix the fragmentation. The multiple expands where the boardroom story and the fan story end up being the same. And we think that TKO is one structural fix away from being a generational asset. So, do you still think that these guys are, the wrestling people? So you see the numbers, the core assets, UFC, WWE, IMG, On Location, PBR. The fight was never the product for TKO. The attention was always the product. And we just want to leave you with this. TKO is not a sports company that has a media strategy. It's a media company that uses sports as its content engine. 3 moves we suggested when they have 1 window, 1 bet. Thank you.
Thank you.